associated with an AI institute at the University of Florida through one of my companies and some mutual friends. University of Florida, yeah, it's a great state university, but what people don't realize, everyone's like, well, if it's not Harvard or MIT, why would I care? But these, the big state universities, I mean, Governor DeSantis just gave them $100 million and said, hey, knock yourself out. We want to make Gainesville, Florida, which is where the University of Florida is located, into basically the Silicon Valley of AI. So when we say Silicon Valley, everyone, San Jose and Cupertino and that whole South Bay area. When we think of medical research, we think of the Research Triangle in North Carolina, Raleigh, Durham, Winston-Salem, Chapel Hill, etc. So there are these, it's not that it doesn't exist anywhere else, but there are these centers, and it makes sense. Really smart, talented people in the field want to be with other smart, talented people in the field. And if there's a certain center of gravity, they go there. So that's the effort. But one of the alumni, I had to, when I was down there, I went into the bookstore because I had to buy like a fleece with a gator on it. Because you go to the boardroom with the dean or the president of the University of Florida, whatever, and you're sitting around. You're a presenter, but you got 4 or 5 alumni there. And when it's your turn to speak, they say, "Go Gators!" And then they proceed with whatever slideshow or deck. I haven't quite got the hang of that, but it's always "Go Gators." So I bought a fleece with a gator on it, just kind of get with the program. But one of their alumni major benefactors is the co-founder of NVIDIA, and he has given them as a gift. I believe it was 12 or more of the absolute top line NVIDIA processors. These are the things you use for, Bitcoin mining and things like that. And they've got the 23rd or so fastest computer in the world, but over half of those are the computers that fast are in government agencies. So to talk about something that's not a government agency, although it is a state university, it's like the 4th or 5th fastest computer in the world. So my team had access to it for our research. So I'm kind of in the AI world as you described it, and it's powerful, it's impressive, it works. I'm not taking anything away from it. The thing you mentioned, Brian, that was
ChatGPT, the OpenAI piece that it put out. It's kind of a large language generative AI.
Right. And I've done a lot of work in that area, natural language processing, because, how can you read 5,000 newspapers? Even I can't do that. So, you use AI to scan all that. Look, it's powerful stuff. It's coming. It's getting stronger. It's not intelligent. I mean, it's a really, really fast, good, nimble computer system. It has enormous uses and it's going to get bigger in the future. But don't ever, not you, but just, kind of our audience, don't ever mistake any computer program anywhere for what's up here, you, me, and our audience. It doesn't compare to the brain. It's not even close. Now, I did read, look, first of all these things have coders and developers behind them. And some are far more sophisticated than others, but a lot of these guys, and some women, but it's kind of predominantly men, they're like 26-year-old PhDs from Bangalore or someplace, and they're really, really, really smart, really good at what they do, but they don't get out a lot. And what I mean by that is they don't know Wall Street. They don't know strategy. They don't know war. They don't know history. They don't know all the things we've been talking about and that you, kind of present to your audience, on a pretty regular basis. And they don't know behavioral psychology. The last time I saw the wheel, it was like 120 biases, cognitive biases that have been identified by researchers we all know about, recency bias and anchoring bias and, various forms of selection where we favor what we believe to be true without having an open mind about whether it actually is or not, et cetera. So those are all, and also new branches of applied mathematics are coming along. So those are all important toolkits to combine with the computer development that we're talking about. I did read one, and I'm not I'm not dumping on the stock. I'm not touting stocks, but the company you mentioned, it was like so good. Artificial intelligence was so good. You could ask it a question in plain language and it would give you an answer. But you could also ask it to compose a poem or a song, etc. And so what the researcher did was, could you compose a list of the good qualities of Donald Trump? And the computer came back and said, I cannot do that because we are programmed to avoid hate, violence, and racism, and Trump's an example of that, so I'm not going to answer your question. And then you say, could you compose a list of the good qualities of Joe Biden? It'll give you a list. You run out of paper kind of printing it out. But you can look this up. This is a real experiment. And then so then could you compose a poem? It was like some poem to Joe Biden or Barack Obama, you name it. And could you compose a poem about Trump? And it did, but it was like he's the nastiest guy under the sky, whatever. So the point is, good, high speed, sophisticated, cutting. I don't doubt that. And maybe it does have a $30 billion valuation or whatever number they're throwing around. I don't doubt that either. But it doesn't work. I mean, it's because it has these embedded viruses. Again, I always come back to and I'm picking on India, and that's not exactly fair, but it's the 26, 27-year-old developer from Bangalore or Pakistan or someplace who does what he's told. And when we look at the Twitter files, we look at how we knew the biases were there. We knew that, but to actually prove it, to actually open the curtain and see what was said between the FBI and Twitter and the CIA and Twitter and the White House, and not just, hey, would you take a look at this? It's like, no, ordering them. Get this guy, shut him down now, close out the YouTube account, which, et cetera, and extensive. This is going to be pouring out for months, and thank goodness Elon Musk cares more about the First Amendment and free speech than he does about $200 billion. By the way, I'll make a comment. This is pure speculation. I can't prove this, and I'll just preface it by saying this is speculation. I was kind of a bear on Tesla. It's like, why are you going to pay a premium? Volkswagen has EVs, Audi has EVs, General Motors has gone all EV. I was kind of, but you get hammered every time. Like Musk was a genius at talking the stock up, creating the buzz, et cetera, et cetera. So, give him credit for that. But, so he buys Twitter. He opens the curtain. He pours out all the dirt, all the legal violations that this will be play out, all the behind the scenes, FBI penetration, et cetera. And all of a sudden he loses $200 billion. What's up with that? Is it, don't talk to me about fundamentals because that's been true for 10 years. Is this like, Larry Fink, our aspiring Secretary of the Treasury, and a couple state pension directors in Democratic states and a few other hardball players deciding we're going to teach this guy a lesson? That's speculation. I'm not asserting it. I can't prove it, but it's a question I think about. Brian, so let's go back to Brazil, Mexico, Argentina, the Latin American debt crisis, broadly defined in the early 1980s. That played out, the intense phase lasted about 3 years, 82, 83, 84. It wasn't until 1990 that we got around to Brady bonds, which were the ultimate refinancing technique. But the intense period lasted about 3 years. Come forward to 1998, long-term capital management. That was about 3 months. That was July, August, September 1998. SVB was 3 days or less. It was like Wednesday, Thursday, Friday, and done. And I talked to a guy. No reason to mention names, but runs one of the largest endowments in the world. And he said, Jim, we moved. We were moving $8 billion out of Silicon Valley Bank, and we got the wire transfer request in, but we didn't know because you get to close business Thursday. We didn't know until Sunday that the money was going to move. We got a confirmation on Monday. We didn't end up moving the money, but there was about a 48-hour period there from Friday to Sunday when no one knew that the wires had been completed. The recipients didn't have them. It was just in limbo, and it worked out. One of the big crypto promoters. They forget the name. Well, the particular name of the bank, but they backed one of the stable coins, actually it's USDC, had $3 billion in Silicon Valley Bank. And they talked about, all these small entrepreneurs and startups, they got 100 employees and 5 million in working capital, and that money's gone and they're all going to fail. There was something to that, but the fact is you had Roku, Cisco, eBay. I mean, there were huge companies with multi-billion-dollar deposits in that bank. It wasn't all a bunch of little guys. So, but yeah, you can. In the old days, you had to line up around the block, and maybe it was raining. You're standing there in the rain, waiting for your turn to get up to the tower. Now you can be in line at McDonald's, with your cell phone, and just a couple hits, QR code, and boom, $10 million is gone. And what Peter Thiel did, and he was right. I mean, I'm not criticizing him. He got his own money out, but he sent out like an SOS to Silicon Valley. He said, all of you, whoever you are, get your money out now. And a lot of people did, and that was that $40 billion. So the time frame is becoming more compressed because of technology. You're exactly right about that, which means that the response function has to be equally compressed, or else you are going to have all the consequences of an honest to goodness global financial crisis. So, and I'm not sure if everyone knows the sequence, but on Friday night, March 10th, the FDIC took over Silicon Valley Bank, and they issued a press release, and they said, here's what we're doing. We're taking over. We're putting it into what's called a receivership. Anyone with $250,000 or less, your deposits are fully insured. No worries. You'll have your money Monday morning. And over $250,000, your deposits are gone. They didn't say frozen. They didn't say suspended. They said gone. And they gave you a receivership certificate, basically an unsecured printed up IOU from the FDIC, but not money. And it's a receivership certificate. And they said, hang on to them. In effect, we're going to sell assets. And as and when we realize proceeds from assets, we'll give you something. We'll give you distributions on these things. Don't know how much, don't know when. We'll do the best we can. Remember in the RTC days in the early 90s, it took them 2 years, and they were very efficient. I worked with them at the time. We were in their offices when we were sitting on boxes because they didn't even have furniture, but they were doing deals. So they had the right attitude, but that took 2 years. So, and that was it. Well, that's when I call the billionaire crybabies came out and forced, Bill Ackman, all these guys. Oh, you got to save us, I was like, well, you got to trade on Bill. $5 billion is not enough. But anyway, they pounded on the White House all weekend. Now here's something that very few people, almost nobody knew at the time except the management, although they seem to be asleep at the switch. Everyone's like, yeah, startups, venture capital. There's a lot of truth to that. 97% of the deposits at Silicon Valley Bank were uninsured. And by the way, that's my new metric for assessing banks. You used to look at, working capital and debt equity ratios and, bad assets, governments. There are lots of ways to measure the health of a bank. But the most relevant way right now is, and this is publicly available, take the ratio of uninsured deposits to total deposits. 30% is comfortable. If you're like, 70% of my deposits are insured, which means they're not panicky. They're not necessarily going to run for the hills. 30%, okay, uninsured, but I have assets. I have that much cash or more. That's a comfortable ratio. When you get over 50, you're in the danger zone. Well, Silicon Valley Bank was 97% uninsured, which meant all the money was going to run, and it did. So that's the way, if you're looking at these big banks or any institution or your own savings institution to look at it. But Silicon Valley Bank was a climate bank. Were they investing in startups? Yes. Were they investing in technology? Yes. But these were climate. These were green new scam startups looking at battery technology, chemistry, physics, to try to make a better battery. But not much improvement in the battery in 200 years. But they're working on it. Wind turbines. Other sustainable fuel alternatives, et cetera. Again, I'm not do that if you like, if that's your field of research, but so much is subsidized by the government and then further subsidized by Silicon Valley Bank. And that's where the assets were. That's where the loans were by and large. And so the White House is getting hammered, not only because of entrepreneurs, job losses. And by the way, we are in an election cycle here in the United States, but from the greenies who are extremely powerful. So that was Friday night. So Saturday, everyone's crying to the White House. Sunday night at 6 o'clock. By the way, mark that on your calendar. Sunday, 6 p.m. is when they tell you what they're going to do. 6 p.m. Sunday, November 12th. They came out on, March 12th. They came out on Silicon Valley Bank. The following week, 19th, that was Credit Suisse. I don't own any cryptos. I don't recommend them. I'm not a crypto basher. I'm like, hey, if you like them, knock yourself out, go get some. But the pushback you get, and you know what it's like, Brian. People go, "Oh, you're a dinosaur. You're a Neanderthal. You don't understand technology." Blah blah blah. I mean, I was writing code in 1969. My partner was the future chairman of CEO of IBM. I do know about it. I was in crypto versus gold debates in 2010. And I read Satoshi Nakamoto's paper when it came out. Okay. I was doing this from 2010, and I followed it all the way through. So do I own it? Do I recommend it? No. But do I understand it? Yes, I get it. Blockchain's been around since the 1980s. It's not new technology. It has applications that have nothing to do with cryptocurrencies. And yeah, blockchain it's a ledger. It's a particular kind of ledger. It has some outright benefits, and it will be with us. And that's good. It can simplify and lower costs on a lot of different processes. As far as cryptocurrencies themselves are concerned, I studied it for 10 years or longer, or 13 years at this point, but it took me a really long time to understand it. Again, technology, the math, the mining, the hash rate, I got all that stuff. But I'm like, what's there and what's behind this? I always go back to Gerstein. There's no there. And what fascinated me, particularly over the last 3 or 4 years, is that the crypto universe, crypto groupies, they replicated the ecosystem of Wall Street. So you start out with the coins. Bitcoin's a coin. You mine it, etc. But that's all it is. Has uses, some good, some bad. But then they said, well, how about a depository? How about a custodian? How about an exchange? How about technical charts, candlesticks, trend lines, resistance, on and on and on, so that you completely replicated the entire structure of Wall Street: exchanges, banks, custodians, technicians, analysts, etc., trading, hedging, derivatives, options, futures. It was all there, with one big difference, which is, just take Tesla for an example. You may like Tesla, you may not, but they actually make cars. There is, you can drive one. And it doesn't have to be tangible. It can be a service, an insurance company. They do something. There was nothing at the center of this. There was the token itself, but the token itself, I mean, I always make a point of saying that every graphical representation of Bitcoin I've ever seen is a gold coin. It's just a gold coin. What's up with that? You're sort of saying something about gold, if you ask me. Why is it a coin? It's not a coin. It's a couple electrons, and it's certainly not gold. But they love to show it as a gold coin, as if somehow you're getting a gold coin, and you're not. But so what's there? And I did come up with two, I'll say theories, but I think they fit really well. The first is it's a casino chip. So I walk into a casino, put $1,000 down on the roulette table, like that game. The croupier hands me the chips. I bet I can win money or lose money. But that's on me. But at the end of the day, I take the chips to the cashier and get my cash back and walk outside. I can't take the chips outside. I can't buy dinner at a restaurant across the street with casino chips. In other words, the Bitcoin has some utility and value, and you can make money or lose money. Believe me, I know people have made tens of billions of dollars, and I've spoken to Michael Saylor. He was up 6 billion. Now I think he's down 6 billion. But so that's real. But it's not different than gambling. And maybe the odds are different, but it's basically a casino chip. You can gamble in the casino. You can make money or lose money, but you got to cash it in, which is basically going to a portal and getting your dollars back, which everyone tried to do with FTX, and they found that the dollars weren't there. And we'll see what happens with Tether. But it's nothing more than that. The other theory, and this took a long time, and this goes back to work I did in the 1960s, is using communications theory. And here we're way into Walter Ong, Marshall McLuhan. He was pretty good friends with Timothy Leary, and Eric Havelock, who did a study of Plato that explain why Plato hated Homer. Scholars like, why did Plato hate Homer? He's a good poet. Well, Homer wasn't a poet. He was an encyclopedist who actually did everything orally. And it was the shift from the oral to the written to phonetic language that marked that was the demarcation of Plato. Plato said, we got to get rid of this oral stuff and start writing and reading. But now 2,500 years later, we're coming out the other end of the tunnel. No one reads anymore. We're back to what we're doing: audio, video, digital representation of various forms. What's an emoji? An emoji is a hieroglyphic, which is a non-phonetic language. So we're actually getting back to a Homeric, oral, AURAL, tactile world. And Bitcoin fits right in because it's digital, it's electronic. This kind of McLuhan traces back to the telegraph. So the point being, it's best understood as an hallucinogen. Everyone sees what they want to see. And it's very tribal. And McLuhan said, when I say tribal, don't think of a bunch of people sitting around the fireplace saying kumbaya. It's not civilization. Tribal society is very violent. So I view cryptocurrencies as part of an electronic, digital, oral, tactile society that's abandoning the phonetic alphabet, getting back to drums or, Homer, but a very different kind of society that is very good at myth making and can be violent. Whatever your baseline is, probably treasuries, 2-year notes or 5-year notes or whatever, they will come down a lot. Not right away. We may still be a month or two away on this, but they'll come down a lot. And then corporate yields will go up a lot because of the recession, because of deterioration, increased bankruptcies, reduced revenues, et cetera. And so those spreads will blow out. And it's important to remember, I'll go back to my entry-level credit training at Citibank in the late 1970s, but they actually made us learn stuff. The interest rates are a lagging indicator. Everyone's like, well, how could interest rates be going up if we're in a recession? The answer is, as you get closer to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and new orders are being slashed, you're not moving anything by truck. So there are certain businesses that are concurrent. So it's kind of the yield curves I was talking about are very good forward indicators. They tell you what's going to happen next. A lot of business people are living in the real world in real time. They know what's happening now, and the stock market tends to figure it out later. But as far as banking and credit is concerned, what happens is if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. If I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I don't want material adverse average change clauses kicking in. Instead, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards. They stop doing loans. And then interest rates will start to come down. But interest rates peak after the recession has already begun. So interest rates may not have peaked yet. I mean, even the treasury market. So that's not unusual. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then, there's what I call the reality. And I guess I'm a storyteller here, but, what I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. They probably are at the so-called terminal rate. They just don't know it. They're going to keep going for the reasons I explained. That means they're going to make it worse. They're going to make the recession even worse. And they may pivot to say that there could be a rate cut. It won't be in April, but, rate cut in August, maybe. I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. They over tightened. They didn't look at the forward indicators I described, and they found out too late. And then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes, and then pivot. And we've seen this movie before. This is exactly what happened in 2018. I mean, I don't know. Attention spans seem to be short these days, but it wasn't that long ago. Go back and look at a chart, any stock index chart from October 1st, 2018 to December 24th, 2018. Less than 3 months. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? It dropped 20%, culminating in the Christmas Eve massacre, December 24th, 2018, when it dropped, I think NASDAQ dropped like 3% in one day. Now, here's the point. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre, and after most of the 20% collapse had already happened. They tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets. And that's the key word. It's not, if stocks are going down, but it's, kind of little, 0.5% a day, 1% a day, trending down, lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic, it dropped like 30% in like 2 or 3 weeks. The fall of 2008. I mean, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly, but not just because they're going down. So right now they're going down, but we had a recent rally, but this is the third one. We had a rally in July and early August. We had another rally in October, but they both corrected. The August rally corrected in September. The October rally corrected in November and December. And this January rally is going to correct also, maybe hard. But the Fed, again, that's not enough to get the Fed to act, but a so-called disorderly crash will. But that may happen. In fact, I expect it will, but we're not there yet. So there may be a pivot, in late August, or July thereabouts, but not because of Goldilocks, but because it's not a soft landing, it's a crash landing. And so I agree with the market that we're going to get a pivot, but I completely disagree. In my fairy tale, Little Red Riding Hood gets eaten by the wolf, but I think the bottom could be a lot lower than even the people say recession, little correction. I think it's going to be worse. Sorry, the recession is going to be worse than analysts expect, and the bottom is going to be lower than analysts expect. We could be looking from the current levels. Bear in mind, we're down significantly from January 1st, 2022. In the case of NASDAQ, the turnaround actually started in November 2021. So we're down from those levels. We've kind of maybe reached some moving average, but we're nowhere near the old highs. But that it could easily go down 30%, and it wouldn't shock me if it was down 50%. You're looking at, S&P, 2,000, 2,100, something like that. First of all, we're seeing it already. So, I don't match the company the exact number, but layoffs on order of magnitude 10,000 to 20,000 terminated employees at Google, Amazon, Facebook, and other tech names. It affects other sectors as well, but tech in particular has engaged in a massive series of layoffs. And so people go, well, wait a second, how come it hasn't shown up in the unemployment numbers? Because the unemployment rate is it's around 3.5, 3.6 on the exact number. It's right in that neighborhood, 3.5, 3.6. We haven't seen that level of unemployment, that low, that is, since the 1960s. This isn't like, oh, a good year or a good day. This is the lowest since the 1960s. And the Fed is absolutely looking at that. You're right about that, Adam. And they're saying, and of course, they believe in the Phillips curve, which is junk science. But the Phillips curve, for those who are not familiar, says there's an inverse relationship between unemployment and inflation. So if unemployment is high, inflation is low. And if unemployment comes down, inflation goes up. And so if you want to get inflation down, you should expect to bring unemployment up. That's what the Fed believes. What I just said is nonsense. It's not true. If you think of a matrix of unemployment and inflation, what did we have in the late 1970s? We had high unemployment and high inflation. What did we have between 2009 and 2019? We had low unemployment and low inflation. Right. Now, there's another problem. It's even scarier, and this is a central banker's worst nightmare. I talked about how the Fed is blundering because they're raising rates too high, too fast, et cetera, and they are. But the Fed has always said, we don't worry about inflation. We don't like it, but we know how to get rid of it. We just raise rates, and maybe they got to raise them longer and further than people expect, and maybe it's painful. There are costs involved, but they can kill inflation just by raising rates. They don't know how to stop deflation. I mean, how do you stop deflation? You can't raise rates. That'll make it worse. You can go to zero, but that doesn't, once you're at zero, you're at zero. QE doesn't work, by the way. It's been tried to the tune of like $9 trillion, but the empirical evidence is that it's just, they do QE by buying bonds from the banks, and the banks take the money and give it back to the Fed as excess reserves. That money never goes to the economy. What good does that do? And the answer is it doesn't do any good. So so you can take rates to zero, but you're stuck. Could you have negative interest rates? In theory, yes. In Europe, Switzerland, and Japan did. But there's no evidence that it provided any stimulus. I mean, they did it, but it's like an experiment that didn't work. So the problem with deflation is there's nothing a central bank can do, and it does feed on itself, and it does get worse, and that is a central banker's worst nightmare. And however, quick footnote, we did see this in the 1930s, well, between 1929 and 1933, during the first phase of the Great Depression. It was the Hoover administration. Then Franklin Roosevelt came in 1933, and Roosevelt faced exactly the same problem. I mean, he shut every bank in America on like his second or third day in office. By executive order, he closed every bank in America. Can you imagine the President of the United States today? I don't care if it's, Biden or Trump or anybody else, Democrat or Republican, issuing an order saying every bank is closed as of now. We'll get back to you when they're going to reopen. And that's what FDR did to break the banking panic. But he still had the deflation problem, and the Fed couldn't do anything. I talked to Ben Bernanke about this personally because Bernanke wrote a book on this, and I read the book, and I said, Mr. Chairman, I said, here's what I think you said. Did I get this right? He said, yeah, that's it. You understand it correctly. But the Fed couldn't and didn't do anything. So how did FDR break the back of deflation when the central banks were powerless? The answer is he raised the price of gold. He devalued the dollar against gold and raised the price of gold 75%. From $20 an ounce to $35 an ounce. And that worked because it wasn't about rewarding holders of gold. In fact, he had confiscated all the gold beforehand, so it was like insider trading. But the idea of raising the price of gold was really to devalue the dollar so you could get the price of corn, wheat, steel, oil, get the price of everything else up. And it worked. In the middle of the Great Depression, from 1933 to 1936, the market boomed. I mean, the economy did very well, but it was starting from such a low level. It was still depressed, but it did much better. The Democratic theme song was "Happy Days Are Here Again." Then in 1937, the Fed screwed it up again and caused a second recession in the Great Depression, and that's why they call it the Great Depression. But the devaluation of the dollar against gold worked. Nothing the central bank could do would work. Deflation is very troubling and should be. to central bankers, economists, and everyday citizens, everyday Americans, because it raises real interest rates really steeply. It feeds on itself, and there's nothing central banks can do about it. And the only thing that has ever worked is devaluing the dollar against gold. So it's one reason to have gold. But we're looking at a global recession, and those are rare. As I said before, it's one thing if Germany has a recession or Japan or the U.S., but usually there's another economy or economic group that's doing okay or at least better and can kind of pull everybody out of the rut. But global recessions where everybody is declining are rare, and that's what's happening. And that's what we had in 2008. Pardon me. So the U.S. is heading for one. We've just talked about that at length. Japan's in a recession. Europe's in a recession. China's in a recession. India's, having some tough times. And a lot of this is dollar related. All the other countries, I mentioned Switzerland, India, China, Japan have all seen their U.S. dollar reserves go down. And everyone's like, oh, they hate the dollar. They're dumping the dollar. No, it's the opposite. They don't have enough dollars. So they're selling treasuries to get dollars to bail out their own banks because there's a dollar shortage. So the fact that you see those dollar reserves coming down does not mean that they hate the dollar. It means that they need dollars, that they're short of dollars, and they're so desperate that they are selling treasury securities to get dollars to bail out their own banking systems. So we're well on the way to a global recession. And if you say, well, you got communism, socialism, capitalism, all these different economic systems, all part of this globalized system, how could they all be on the same wavelength at the same time? Well, the common thread is the dollar. It's the US dollar. About 60% of global reserves, 80% of global payments. It's the benchmark for every other currency. So when you talk about the euro, you're quoting dollars. You're saying it's $1.05 or $1.04. Gold, you say, oh, it's $1,800 an ounce, whatever. The point being, even when you're talking about a commodity or currency that's not a dollar per se, you reference it in dollars. Same with oil, world market, it's all dollar oriented. So the dollar is the thread that runs through the whole global system. And it's a partial explanation for why everything's falling apart at once. What's the optimal asset allocation method? Well, the key is diversification. And when you say diversification, people roll their eyes and go, oh, of course, everybody knows that. Diversification's good and all that. But the problem is they don't understand what diversification is. And I run into people all the time, and they go, Jim, I'm highly diversified. I own 50 different stocks in 10 different sectors, telecommunications, semiconductors, mines and minerals, consumer non-durables. So I'm highly diversified. And I say, no, you're not. You may have 50 stocks, but you have one asset class, which is stocks. And they're all going to go down together or go up together, as the case may be. But particularly in times of stress, they become highly correlated. So having 50 different stocks or ETFs or whatever is not diversification. That's just having a whole bunch of bets in one asset class. So what does real diversification look like? Well, you should have some 10-year treasury notes, or if they're a little too volatile for your taste, look at a 5-year note or a 2-year note. That will basically give you very the credit secure. I'm not doubting the credit of the United States, but that will give you a deflationary hedge. If we get into disinflation and deflation where interest rates are coming down, which I do expect, you're going to get very good capital gains on those notes, or you're going to be very happy with the coupon in the meantime. Real estate, definitely. Not so much commercial real estate, too soon for that, but multifamily housing, residential real estate, farms, other kinds of income producing real estate for a slice. Good slice of cash, maybe as much as 30%. And people hate cash. They go, I don't get a yield on cash. Cash is a waste of my time, etc. It's true that it has very low yield, but number one, it performs very well in deflation, which we talked about. But more importantly, cash is the opposite of leverage. It reduces the volatility of the rest of your portfolio. So if you have volatile investments in the wings, cash is it's like a bar connecting two ends of the barbell. It has very low volatility, but most importantly, it gives you optionality. If you see stock markets crashing and burning the way I expect, the way I described, the person with cash can go out and go shopping in the ruins. And by the way, Warren Buffett Berkshire Hathaway has over $130 billion in cash. Why does Buffett have so much cash? Well, he sees what I see. We're looking at the same thing, which is a kind of meltdown where the person with cash can basically go shopping for bargains. Definitely a slice of gold for the reasons we talked about. That'll be your inflation hedge. But 10%, people always say, Jim Rickards says sell everything and buy gold. I've never said that. I don't think that's a good idea, but 10%, yes. So that's a good slice. Private equity, if you can have access to good deals, that's a separate category. And so a model portfolio, you'd have a slice of treasury notes, a slice of cash, have some stocks, but I would focus on, for example, energy, BP, Exxon, Mobil, Shell, Marathon, this Green New Scam thing, forget it. It's a big deal, from a policy point of view, but it's infeasible. I've studied the science very closely. It's going to go away. But in the meantime, if you bash the oil and natural gas companies, but you're going to need the oil and natural gas, which we do, then those stocks are going to do well. Real estate, I mentioned, and gold. So that would be a really diverse portfolio. I don't have $100 billion, so maybe there's a level where you got enough money and it's not your primary concern. I like making money, but it's not what the first thing I think about when I wake up in the morning. The first thing I think about is how do you solve problems and what's going on. It must seems to have some of that, maybe more than a little. Look, if you don't have free speech and you abandon the Constitution, is this like the fall of the Roman Republic? There's a little bit of a uncomfortable resemblance. Again, going back to what we said earlier, you got to study history. It's certainly not the same, but there's no better playbook for doing analysis and a really good understanding of history. It's why today in America, and I would say not just communists, but neo-fascists and other forms of dictators, and we have plenty of those in Washington. One of the first things they kill in the curriculum is history. They stop teaching it because if you knew a lot of history, you'd see these things for what they are. But I had some pretty good history teachers, and I've always been interested in it. So I was shocked by what's revealed, even though I've been around enough to maybe not be shocked, but just the extent of it and the depth of it. And I have a lot of sympathy for the users who were suppressed and squashed and deplatformed, and even more sympathy for the victims of that kind of censorship.
So we were on the front lines of that information war in 2020. And so when I see these files, I see it from a slightly different angle. April 6, 2020, we had the second largest YouTube live stream in the world that day, Jim. 65,000 concurrent viewers watch me in this studio have a 2.5 hour conversation where things were questioned as far as efficacy of a PCR test, masks, future vaccination policies, which were really early. Even origination of the virus might have come out of Wuhan, something they'd literally almost lock you up if you had mentioned that in April of 2020. 30 minutes after that, Jim, for the first time in my 9-year history of London Real, a video of mine on YouTube was deleted and banned. And I thought, what is going on here? I thought the weirdos are the people that got censored in this world. And then after that, I was subsequently shadow banned from the following platforms: LinkedIn, Facebook, Instagram, Dropbox, PayPal, right? But 6 figures of balances on PayPal. Dropbox, where I didn't think they were watching my videos. That's technically my information. And again, I'm not a conspiracy theorist. I leave that to the guests on my show that come on, because I think they have the right for free speech and we should all listen to what they have to say. But when I saw those Twitter files for the first time, Jim, I thought, okay, if there was a coordinated effort, it would have to come from a single source, and why not come from someone who's trying to say, please, can we stop people talking about X? So I saw it in a slightly different way, to where I was like, oh, okay, now I could see maybe how that coordination could happen.
And I like the way you put it, Brian. You said with this guest, this particular show, you were questioning things. You weren't being categorical about this. You say, well, maybe it did come from Wuhan. That's what you're supposed to do. My book, the New Great Depression, came out in January 2021. Interestingly, the publication date was delayed because of the supply chain, which was my next book. But I had it pretty much done by the summer 2020. And what strikes me was the evidence was there then. Now, 2 years later, you're watching whatever, Tucker Carlson or Alex Berenson or others. I'm sure there are many in the UK, and they're saying, do you know that the masks don't work and the lockdowns don't work and this thing looks like it came from Wuhan? I was like, yeah, I do. And I said that in 2020, but the point is the evidence was there. It wasn't guesswork. I'll give you a real quick example. The leading epidemiologist for virologists of the 20th century, maybe all time, is Dr. D.A. Henderson. Now, D.A. Henderson's not a household name, but if there's a single individual most responsible for eradicating smallpox on the planet Earth, it was D.A. Henderson. He won the Presidential Medal of Freedom, which is our highest civilian honor, equivalent to the Congressional Medal of Honor in the military, dean of the Bloomberg Johns Hopkins School of Public Health. I mean, you can't go any higher in the profession, have more respect than D.A. Henderson. He wrote a paper in 2005 that said lockdowns don't work. And he had the research to back it up. This was at the time, I believe it was the swine flu was going. There was an avian flu and a swine flu during the Bush administration. Bush was actually very concerned about it. And Henderson wrote this paper, said they don't work. And I cited that in my book. But the point is, we didn't have to wait until 2021 or 2022, in China's case, today, to find out that lockdowns don't work. In 2020, we had a paper from 2005 that said the same thing. He said, if you have an island and there's no airstrip and only one way in or out and you got 100 people, maybe, but that's not North America, that's not Europe, that's not the world. They just don't work. Well, if we knew that from the leading epidemiologist, maybe of all time, why didn't we follow that advice? Well, the answer was it was a hidden agenda. They wanted to shut people down. They wanted to basically we empowered the inner fascists in all these government bureaucrats.